The market is looking a bit bearish, if you ask me, and we had some action on Friday at Jackson Hole. Riz and I are going to discuss it here on this Elite webinar. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our Elite webinar. If this is your first time here, my name's Chris. I'm part of Riz International, and we are a group of traders who are looking to better our situation in the market, attain financial freedom, and really, let our money work for us. And to do that, we have the man himself, Riz, here this evening. How you doing, brother?
Doing good, Chris. Yourself?
I'm doing good. It's a good time to be alive. It's a good time to be in the market. And if you want to learn all of the best strategies and what we are keeping an eye on here in the market, make sure you smash that like and subscribe button down there. Click the little bell icon to get notified every time we upload a new video here on the channel. And I have to give you guys a little bit of a hard time, but, all in good fun. But last week, we asked if you liked Riz's view on the SPX or if you liked mine. And I only got one comment, and that's just not acceptable. We had over 100 views, and I want at least 50 comments before I make the big change. Because I like my Christmas tree setup, but Riz isn't such of a fan. So we want to know whose view you like better. If you missed last week's webinar, make sure you click on the annotation, which I'll put up here right now, and you can see what I'm talking about. But let's take a look here at the S&P 500 for this week. So, we had a couple of catalysts that were pretty much really nothing too exciting, but then we had the discussion from Powell on Friday from Jackson Hole. Now, going into that on Thursday, we had an absolutely massive engulfing red candle here. An engulfing candle is one that, completely covers up the last one, where we gapped up early in the morning and then just did a whole bunch of selling all day. And then Friday was just up and down all over the place, especially once Powell took the stage and started flapping his lips, which is always our favorite market catalyst here. But Riz, we've obviously had this huge downtrend here since, let's see, right about the end of July. August has been very bearish. We've talked about before that, seasonality-wise, August is typically a more bearish month, but there was a lot of indecision on Friday. What do you make of that?
Yes, Friday was very interesting for a few reasons. Obviously, we had Jackson Hole seminar or symposium where Powell spoke about 10:05 p.m. a.m. Eastern. I was listening to it live. It's funny, I was listening to it live while I had about a $1.1 million short position on S&P 500 futures. And I was actually sharing that play by play every time I would enter or exit for Elite. And that was wild. That was wild. Now, I will say, for when it comes to futures, people are like, Riz, that may have seen the P&L either on an Elite or maybe even on social media, like Instagram. They'll be like, Riz, but you had, a 1 million or 800K or 1.1 million because it changed because I scaled out position, but you only made 5K. That's pretty weak. And I'm like, yeah, but that's my notional exposure. Like, I have 1.1 million total at peak exposure to the S&P 500 index, but the capital that I actually used for that trade in terms of buying power was around $50,000, right? So for the futures, we get massive amounts of leverage. It's part of the instrument itself. So for those wondering, well, that's a horrible percentage, return. Yeah, if you don't understand how futures work,
Yeah, exactly.
which is why I thought I'd clarify. But let's just say 5,700 is what I made in about 30 minutes of scalping futures through the Powell conference catalyst. It was wild. Definitely a little bit hairy to do so, but hey, the actual commitment from a buying power standpoint, capital allocation standpoint, was just 50K. So 10% in about half an hour, not bad, right?
I'd take that any day.
Yeah, so it was a pretty good setup. I'm glad I executed that well compared to like maybe a few weeks ago where I remember I made that big mistake intraday. I think it was back in July, obviously. I think or was it this month? I can't remember if it was this month, but I think it was. Okay, maybe. Yeah. So
Yeah, it
it
was.
was
It was.
interesting.
It was like a week ago, actually. I
Yeah,
know. I know. It
yeah.
feels like a month, but it actually is.
Okay. All right. Yeah. So yeah, I'm glad I kind of got this one right. And of course, I learned from my mistake last time around. But it's crazy because the market puked, and obviously I made money on the trade. I was right. I'm glad with my exit. I exited at the right time, entered at the right time, obviously as well. And then I'm glad I didn't carry it any further than that half an hour in the morning, because eventually the market went and completely tore the faces off of everyone who was short still, and reversed and went up and closed like what 0.80% or something, 80 basis points or something like that on the day. Um, so it was a very volatile intraday. Now, the reason being, Powell did say that, okay, we're going to keep rates higher, longer than expected. He even said we might even do a raise, and the actual probabilities of having a rate cut, as the market was pricing it in before, we're expecting a rate cut this year. Nuh-uh. That's completely been overruled now, and now the market, the dot plot, especially the bond market, is now potentially saying a rate cut could happen sometime early 2024, or maybe even the latter half of 2024. That's a big shift. And Chris, we knew this. We were talking about this many times. I said we're not going to see a rate cut. Obviously, I can't speak for Powell and the other Fed members, but I think I'll have a little bit of a handle on things. And I was like, you know what, the market's pricing in a rate cut this year. Hell no. And I think that's what we've been seeing this August. Apart from seasonality, there's reasons why, right? We see these moves, and I think the market's been warming up to this fact that, look, we may see rates at these levels without cutting. Doesn't mean we're going to guarantee to see an increase, because a lot of people are like either one or two camps, increase or decrease. But there's actually a third option, which is probably the most plausible option, which is holding for the next few months, at the very least. And I think that's going to happen. Right now, the odds of a rate hike next month, in next month's meeting, are up a little bit, but they're still, I think, around, last I checked after the conference, still around 25-30% for another hike. But as far as cuts, market now will be looking to price that in if they haven't already. Maybe, there's two sides of the camp on this. Some say maybe it's already priced it in now. Obviously, the market's down from 4,600 high of this year. Again, not all-time high, but just high for the year. And now we're at about 4,400. We did reach a low of like 4,350 this August. So it remains to be seen. I personally feel like maybe we could see a little bit more of a pullback. We did see that massive bearish candle on Thursday, as you said, very bearish, engulfing there right off that what is that, 50-day moving average, I think.
It's 50.
Right. So I feel like not only from a technical standpoint that was very bearish, but after everything Powell said, yeah, the market completed a 180 from the morning and then, went green and went up. But I think that might have been like maybe like a post, how I can't relate because I've never drank, but maybe it's like a hangover type of move, like after the fact,
Oh, so we're having our rebound the day after, right? Where we're doing hair of the dog
There
and
you
stuff
go.
like that. Okay.
Yeah, there
Gotcha.
you go. You get it, right?
I'm with you.
So like I think that might happen. It's going to be interesting because right now we are talking, as we're recording this, as we're doing this live. This is actually on a Sunday. Usually it's
Yep.
Saturday. So I can tell you, because it's a Sunday and we're doing this after 6 p.m. Futures are open. They did open around plus 20 basis points.
Okay.
So 0.20% up. Right now they're up maybe 0.07%. So that's a little bit of a give back from the open, but hey, it's only 2 hours in. Tonight it's going to be fun. I'm thinking of maybe getting plastered, not from a drinking standpoint. Well, I will be drinking something, but it won't be alcohol, Chris. You know what it's going to be.
Oh, I know.
So it might be a long night for me, and I think I'm ready. Plus, I'm excited for another opportunity that I'm going to be doing something pretty heavy and like hairy as well. It's going to be both tomorrow, but I'm only going to share that in Elite. And for those
Nice.
that will have the ability to take it, I think we can make a lot of fucking money doing that. But that's only for Elite, and of course for those that have the ability to take that kind of trade. But it's amazing.
Yeah.
I'm going to share it tomorrow.
I'm looking forward to seeing that. That's going to be really cool. But yeah, it's been interesting, like seeing all of this euphoria, expecting rate cuts when, I mean, to me, it didn't make any sense at all what they would cut rates. But yeah, obviously now we're seeing the result of that, the market kind of waking up to the fact that, oh, I guess they really meant what they said when they said they weren't going to be cutting rates this year. And
Yeah,
yeah, that's kind of the result right here is what we're
Powell's
seeing.
Powell's been saying that. Obviously,
I
the market
know.
doesn't believe him because he's a softie. No one wants to believe what he has to say. But you're right. He's been saying it. He's been talking down the market literally. And it's kind of funny because the market's like, "Fuck you, Powell.
Yeah, they're
We
just kind of
don't
giving him the
believe a
finger.
word coming out of your mouth." And that is straight disrespect. But hey, you
Yeah.
know what? That's the ultimate disrespect to Powell. But it's funny. I find it pretty ironic. We got the Fed chair going on conference after conference saying, yeah, we're going to keep rates high. Yeah, we need to bring inflation down to 2%. Yeah, we might not cut rates. The market's like, nah, fuck you. Right. And it's just comical. And Chris, you were pretty cut and dry around saying over the last few months that, look, we're not going to get rate cuts. We might even get a rate hike. We obviously got one 25 basis point. Was it this month? Fuck, I can't even remember.
I believe so.
Yeah, it was this month, right? Like a couple
Yep.
weeks ago, we got a rate hike. And then, yeah, we got next month. We'll see how that goes. But I think we might have like maybe two more meetings left in the year. Don't quote me on it. And I feel like, yeah, maybe we see one. I doubt we're gonna see two, to be honest. All things concerned, I think we might see one, and then I think that's it. They're just gonna hold. Um, and I think the data will then start changing. I'm not going to give away too much. I know people on YouTube are going to be maybe a little bit salty if you're watching this and you're not an elite. You're going to be like, Rich, go on, give us something. And I'm going to be like, the most juiciest stuff is going to have to stay for elite because I love our members. And for those that are not in it, tough luck. I mean, you know
Need to
what?
get into it if you can, if you get that opportunity when we open up.
Yeah, but it
Uh,
blows my mind, like Chris, like for what people get. I get it,
oh
everyone's
yeah.
in a different situation, but I'm like, fuck, like, uh, you know, see what we have to do, like at least see what we have, and it costs next to nothing. Jesus,
Yep.
like I'm like fuck, like I whenever I open it up, I lose more money because of the failed charges that people do. I lose money because I got to pay the point of sale for failed charges, and I lose money every time I open up because we get people that come in joining try for $2 and then they don't cancel, but then they also keep bouncing payments, and I have to manually look after that. But I lose money every time I open up. I'm like, come on, like just give it a chance. But here we are. I will be leaving kind of what I think will happen with the data, which will be very interesting as we go into the future couple months. We got 4 months left, but the next couple months will be big.
Yeah, that's for sure. All right, let's take a look here at the different market sectors right now at the S&P 500, kind of get a grasp on what's going on. Obviously, tech and communications have been riding high, pretty much since about April. We've been just kind of going nuts here, but we've seen a pullback. Obviously, with the market, these sectors have been kind of coming back. A little bit of a rebound this week, making a bit of a move up. Same here with this consumer discretionaries. People maybe, putting a little bit more of that money into places where they don't necessarily need to, but mostly mirroring the movement of the S&P 500, I would say for the most part, or the SPY ETF is what we're tracking it with here. Energy continues to kind of hold this area right around about plus 3%, while all of the other sectors are below the zero line at this point. We had seen some hope here going into July, and that's when everything turned around. And we're kind of seeing that here with that big turnaround since July. Here's the first day of August, and you can see the market just coming down. But, tech getting a little bit of a bounce this week. I think probably some NVIDIA earnings helped out with that. But financials, healthcare, real estate, consumer staples, and utilities are all in the dumpster at this point, all below zero. Riz, is there anything you want to add to that?
No, it looks like a little bit of a consolidation if you look back for the last week and a
Mm-hmm.
bit.
Yeah, it
But
kind of does.
yeah, I definitely will be interesting to see how we end off the month. This is the last trading week for August, and then we have September, which is of course going to mark the end of Q3, and then we'll be off to the final let's
A
just say
quarter.
3 months of the year. So it's going to be crazy how we do in the holiday season from a data and of course from a market standpoint.
Definitely. All right, let's take a look here at the asset classes that we like to keep an eye on here. And oil kind of cooling off a little bit this month, or not month, rather this last week, but basically just holding, kind of like what we were talking about, a little bit of consolidation here. Looking basically this whole month, or I keep saying month. I apologize. This whole week, basically mostly trading sideways here on oil. Looks like we're running right around $80 a barrel on crude, right in our lovely little channel here that we've been holding definitely for the last month. I can use it now. Gold had taken a bit of a dump here, coming in from about the middle of July, having a bit of a rebound here since about the middle of August and kind of pulling back up, but definitely not at our resistance area around 1967 or so, and definitely nowhere near the all-time high around 2050 per ounce. Riz, with oil, are you kind of expecting this to hold this area for now as we kind of move into the fall? I hate to say that, but we are getting kind of closer to fall every day. Moving into the fall, are we expecting this to kind of hold here, or do you think we may see a bit of a downturn with less demand coming out for oil as we get into the fall months?
Yeah, you said the F word there, Chris. It's
I
a
know
really
I
bad
did.
word. I'm hurt. But
I know, but you
yeah,
said
we
you said a
are.
different F word earlier, and it
I
was
know, I
totally
know, I
cool.
know, I know. The one I said is fine, but the one you said is definitely blasphemous. But no, in all things serious, you're right. It's definitely getting to that point in the season, so to speak. I think based on all things considered, I think we could definitely see these levels hold. We've seen in Canada, but also in the US. I think gas prices, sorry, have been trending upwards. People are feeling a little bit more of the pain. And I assure you, in the next CPI print, we are going to see that impact. That's something to keep an eye on. And we did see that in Canada, and we will see that the same in the US, where prices at the pump have a material uptick in inflation.
Oh yeah.
Unless the other parts of the CPI index are down, to offset that, we could see a hot print in the next one because the gas prices. And you would think, well, it's just gas price. Well, yeah, believe it or not, it's actually a big part, and which is one of the reasons we saw inflation run a little bit hotter than expected, because we did have really high gas prices, if you recall, last year, and even maybe start of the year as well.
Yeah, definitely. I can tell you the gas has been going up in my area. We kind of peaked about a week ago and we've come down a little bit this week, but yeah, still definitely running hot, as you said. And hey, I did not say the Forex, that F word. So, I mean, it can't be
Oh yeah,
completely
definitely.
blasphemous.
That's yeah, yeah.
I,
That word we've kind of cooled on a bit, but
a little bit, but yeah, that's the real F word right there. All right, let's take a look here at the bond yields, and kind of what Riz was talking about here with rates remaining high. We see the bond yields really perking up this week quite a bit, especially the 2-year bonds really looking very bullish actually on the percentage for the yields. Let's see here. 5.09% on the 2-year bonds. Very high, getting here close to this March high that we had, which was 5.07. So actually, did we get there? Yeah. So actually, we're now higher than where we were before. We've completely recovered, the banking quote unquote crisis, that the Silicon Valley debacle that has been completely recovered, for the 2 years, and definitely. Saw a bit of an uptick here going into this week, but a little bit of a cooling here on the 30 and the 10-year yields. And the dollar has really rebounded strong after this big dip that we saw here in the middle of July, and really just kind of pushing up, but yeah, the dollar's dying. I know that's our meme that we talk about here on the channel, but I can't get away from it. It's too funny. But Riz, where are you at with these? Is that kind of what you're thinking, or do you have a different view?
yeah, not surprising these are moving up. We know a lot of it has to do with, of course, rates. A lot of it has to do with the bond market pricing in what they're pricing in, which is a potential slowdown. As I've said many times before, this further exasperates that. This further, drives that point home that, look, we might see rates stay higher than usual, or than like expected initially, and the US dollar following suit also confirms that. I said before that we do see a positive correlation with rates going up and the US dollar getting stronger. And we've seen that apply from the first, second week of July in the US dollar index. And yeah, it's crazy. Honestly, the yields right now, 2-year, because banks and mortgage companies, they utilize spread between a 2-year, 5-year, maybe a 10-year, I think, as well, to essentially come up with mortgage rates. And generally speaking, again, it's not set in stone, but generally speaking, when we see yields, bond yields like these continue to move up, there's a reason we see, maybe in headlines like, okay, the average 30-year fixed mortgage in the US hit like, a recent 23-year high or something, which is something we've been seeing, right? And this applies actually to Canada as well. The US, I think, what is it, like 7% or something, mortgage interest rate for a 30-year. And then in Canada, it's about like anywhere between, five, mostly around 6%. And the reason that is because we don't have a 30-year fixed. The max we can do is a 5-year fixed. The amortization is different. The amortization can be 25, 30 years, but the actual term, meaning the term that you lock in the actual interest rate, is actually 5 years. And a lot of people don't know that. They're like, oh my God, every 5 years you are essentially exposed to whatever the rates are at that time. And that's the truth, right? And it has a pro and a con. It helped us back in 2008. Our banking system was a lot more liquid, a lot more secure, a lot more conservative in the risks they took back in 08. But this time, I think the roles were reversed, where I'm not saying where there's a housing crisis or a financial collapse, but I think with the rates being where they are, Canadian economy, housing being so disjointed and really fucked up, for lack of a better word, and us not having the ability to have a 10, 15, 20, 30-year, fixed jumbo mortgage lock-in, people are going to be coming up for renewal in the next year or 2 years, and they might have been at a 2%. And all of a sudden, they're going to be faced with triple that. They might be faced with 5.5%, 6% mortgage rate. Just think about that for a second.
Yeah, because what a lot of people don't like to mention is that when you're paying a mortgage, most of your payment goes to the interest, especially for like the first
Yep.
20 odd years before
Yep.
you start really making a dent in that principal.
Yeah, for you guys, the 30-year, because it's a 30-year fixed, obviously amortization's up there as well. A lot of it goes towards the interest portion in the earlier years for sure. And then it decreases incrementally as years go on. And same applies to every mortgage, every
Mhm.
loan. A lot of it goes towards the principal, the interest portion initially. That's by design. But you're right. The longer the term, longer the amortization, the more goes towards the interest. And that's already happening. So here's the thing with Canadian mortgages. We have a 5-year fixed max, but our amortization is still 30 years. So we're
Yep.
renewing every 5 years, but we're still amortizing it for 30 years to keep the payments low. But to keep the payments low, you're ending up paying more interest throughout the life of the mortgage. And most people, it's not uncommon to see people in their 60s that have hundreds of thousands of dollars left on their mortgage. I know it because I've seen it myself. Personally, I can tell you that I've seen quite a bit of ridiculousness. And this was before COVID, right? Think
Mhm.
about that for a second. This is not even during COVID, after COVID, where everything went crazy economically and inflation. I'm talking before that, to more like reasonable times where rates were so low, people were still strapped with massive amounts of mortgages, and they're in their 60s. You can assume that they will probably die, and I don't want to sound grim, but they'll most likely die not having paid off the mortgage.
Wow. That's nuts. All I'm going to say is I'm glad I locked my interest rate in '08 when I got this place. And yeah, we're not letting it go anytime soon unless I get some hot deal coming up. But with interest rates the way they are right now, man, I don't
That's the
think we
thing,
could even afford a new house, even with what I could get out of this.
which is many people are in the same thing. And that's
Yep.
why we see real estate sales in the US, real estate transactions being landlocked. There's nothing
Mhm.
happening. No one wants to sell or leave because look at where the rates are. And then, the people that are looking for a new home, they're stuck where they are, or they may be stuck renting. And guess what? Rents are also extremely high.
Yep.
Uh, it hasn't offset the massive increase in cost for some landlords who had to renew, but they're still extremely high. Rents are still extremely high, and it's crazy where we're kind of heading because there's a lot of similarities between the Canadian and U.S. economy. But I think this time around, the Canadian economy is a lot more exposed and on like on a rickety foundation from a housing standpoint. Um, if you compared it to the past.
Well, one does not want to have a rickety foundation when building a house. You've actually kind of dipped into one of our elite members' questions here. So we'll dig into that a little bit more in a second. Let's go ahead and take a look at the important dates in the market this week. And we've got a couple that are going to be interesting to see and could be potential catalysts. So job openings, always something interesting to see. But more importantly, I think we've got some personal income and personal spending here on Thursday. That should give a good idea of what people were feeling in July. This is the month on month, obviously. So looks like, let's see here. Yeah, about a plus 0.3 on income and plus 0.4 on spending. So that could be interesting, as far as if the forecast and the consensus, kind of line up or not. Obviously, there's a bit of a divergence here on spending, but the big one is going to be on Friday with the unemployment rate. That always moves the market one way or another. It looks like they're expecting a hold on unemployment rate. I'm going to throw the BS flag on that one. I don't think it's going to hold, but that's just me. Let me know in the comments, as well as checking out our different views for the S&P 500. If you think that unemployment rate is going to hold at 3.5%, or if it will be more or less. I'd love to know your thoughts down there in the comments. Please let us know that. But yeah, Riz, what are you seeing here? Did I miss anything?
Yeah, payrolls, you nailed it. Payrolls, job openings. Job openings first on Tuesday, and then payrolls and unemployment will be important as well. Yeah, personal spending matters as well. Core PCE as well, but unemployment as well as payrolls will be good to see. Are more people getting paid, less people getting paid, less people in the workforce, our jobs being cut on Tuesday, our employers, companies essentially removing jobs and just not hiring for positions, that'll be interesting to see as well. And unemployment, you're right, it's a very low, I think like 50-year lows or something, and it's still holding there, which is pretty, I mean, accurate or not, just going by the numbers at face value is pretty wild considering everything, right? With costs, with affordability, with kind of like this kind of, I would say, air of this heaviness in the air where we don't know kind of what's happening with the economy. We don't know what might be in the horizon. We're at like 20 plus year highs in regards to mortgage rates. We haven't seen interest rates, benchmark rates this high since 2007 or so. So like we have a lot of, I would say, not seen before kind of economic constraints that we haven't seen, and depending on how old someone is, they may not even remember a time where rates were at these levels, whether it's benchmark rates, whether it's mortgage rates, and yeah, we're chugging along, but for how long? When is something gonna give? And the first thing that's gonna give is going to be job openings, and then we see unemployment and payrolls go. That those are things that we see payrolls come down, and we see unemployment go up. So that's the kind of the chain of events. Again, it's not always as binary, but usually that's the thing we want to look for. And I can bet you markets are paying a lot of attention to that. But here's where it might be a mixed bag, where bad news can end up being good news from a market standpoint. If we see unemployment go up in the next few weeks, next month after, even a little bit, the common thought would be, well, look, that's bad for the economy. More people are unemployed. But that could also be looked at from a positive, because the market might think, well, unemployment is going up, economy might be slowing down. That's going to give the Fed more of a reason to, one, not increase rates, and two, maybe even do a potential cut. So that's something I want to prepare everyone for as well, because believe it or not, and as we've seen many times in the past, especially this year, bad news for the economy can end up being potentially good news for the market, simply because of how the Fed will react. And the market likes lower rates. The market likes, cheaper credit, and we know that. And in fact, I would argue it's been juiced and bred on that the last 10 years plus. Going even from 2008 onwards, like we just haven't seen rates these levels. And I would like to think maybe we're in a new world. We've kind of gone past that low rate, next to no rate, because after inflation, at points in time, there were real rates were zero. You were essentially getting, it was favorable to borrow than actually use cash. I'm hoping we get some reasonableness, like we don't see I know people won't agree, but for a broader economic standpoint, we want to see rates at least be real rate positive, above inflation.
And that makes sense. Honestly, because uh, yeah, it was nice, obviously having those low rates, but it just isn't something that's really sustainable long term. And we're seeing the results of that, and we're having to pay the piper for it now,
Yeah,
as
because
they
someone's
say.
got to pay for it. Yeah, we
Yep.
see this, right? Like how much are you going to defer? We kept deferring rate hikes, and then everything got juiced, and then that's why it takes so much longer. It's taking so much longer to get this froth, this juice, like this massive amount of exuberance out of the economy. Why do you think it's taking so long, right? Because we've effectively keep this thing hyped up and propped up for so long,
Yep. You
right?
can only kick the can down the road for so long.
Yeah, yeah, exactly. Hope I'm not making you fall asleep.
No, it's not you. It's been a long day, and I'm exhausted from yesterday. So it's all good, brother. All right. Let's hang on a second. Okay. Before we get to our questions, let's take a look here at the earnings for this week. And a couple of big names on here, but not as much as what we've seen in the last couple of weeks. Obviously, earnings are starting to kind of cool off a little bit, but definitely some big names to keep an eye on here. Best Buy, a favorite of mine. Love going to Best Buy and getting some stuff. I know I'm probably overpaying it. HP Hewlett Packard could be an interesting one here, but really not a lot of big names on this list that I'm seeing that is going to be something I'm going to keep an eye on. I know that a lot of day traders like Dollar General, that's one that I always saw going around, especially on earnings times. If you like over expensive yoga pants, Lululemon is here on Thursday after the close. But really nothing that's really striking my eye as something that I want to keep an eye on. Riz, is there something here that you're watching?
Yeah, most of the earnings season is done. So yeah, we got earnings. I mean, every week there's earnings releases, but earnings season officially, I think it's over. Those 3 weeks of large, big names is done. Now we just have, a few smaller names. Best Buy definitely one. Neo is some the more speculative growth crowd. Obviously, are going to be paying attention to. Of course, Box and HP a little bit, but Box is usually volatile post earnings. We have Salesforce, which is obviously a big one. They're bigger,
Oh yeah.
and CrowdStrike is also, I wouldn't say big, but this one is a large mover as well. So it's very much one of those kinds of weeks where you get large movers. So for those that want to speculate or try and kind of YOLO on these kinds of catalysts, then these are the ones because they usually have large moves. Not always, but usually. And you're right, Dollar General is another, and Lululemon, MongoDB being one as well. Funny name, but it's actually more of like a business software type of deal. VMware and Dell as well. But none overall, very much more of a muted week, and we're going to see that kind of continue for the next few weeks until a month later we're going to start. 2 months later we're going to start seeing earnings season hype come back again.
Yeah, I know lots of people were PMing me and telling me they just couldn't wait for the Mastercraft Bolt Holdings Incorporated to come out on earnings this week. That and overpriced handbags with Vera Bradley. That was definitely high on our people's minds. Here at Riz Elite, and I want to go ahead and encourage our members. If you haven't posted your questions yet, now is the time. I did have people do this beforehand. So we got one here for TSM, Taiwan Semiconductor. All right, so how are we feeling on TSM? So from a technical standpoint, after the sell-off started here in about the middle of June, we kind of bounced off of the 200 simple moving average. We got really close to it here about in the middle of August, but yeah, we really followed the market hard on Thursday with just a little bit of a rebound on Friday. Obviously, there's a lot going on in the South China Sea right now. There's a lot of tension there. I would say it is not as hot as it was previously. Obviously before when we had, the Secretary of the House showing up in Taiwan and, ticking off the Chinese government by doing that. Obviously things were a bit more volatile then, but I would say in general, things in the South China Sea are a bit cooler right now. But I'm not super high on TSM right now. Riz, how are you feeling about it?
Yeah, this one is literally one of the largest Taiwanese companies. Obviously, a big semiconductor company. This company effectively provides all the materials to companies like NVIDIA, so on and so forth, to make their processors, GPUs, and all that stuff. So think of it like this being the nuts and bolts of semiconductors, and definitely a great company. It's definitely good from a valuation standpoint compared to the other actual pure play semiconductors like Nvidia, AMD. But I do agree this is not a very, let's just say, bullish chart right now, because we're kind of a little bit of indecision, like you said, hovering around the 200-day moving average. We did bounce up from it, but then Thursday was very bearish for the market as a whole, and then Friday we had a little bit of uncertainty, volatility. Yeah, we closed green, but I don't think that's enough to say that this 90 area is a for sure a hold, right? So I think if we do dip below 90, and then once we can find a floor, I think that would definitely be interesting for me to consider a potential long. But right now, I'm okay waiting.
Yeah, it's definitely in a downtrend here over the last month and a half. So not very confidence inspiring. Let's put it that way. Jeff, I see your question. I want to do that one last because I think it's a really cool question. I want to cover that. Nikhil wants us to know, how do we feel about PANW? Different than Pan X, I've heard. So PANW looks like we had a pretty nice jump here post earnings. Earnings look to be good for EPS. They missed on revenue a smidge, but nothing really to get too, get your drawers in a knot over. And so we had a very nice gap up here, but we've been selling off into this spike here. I don't personally feel like this is the time to take it long. Honestly, not really confidence inspiring post earnings. So it hasn't been able to hold that area. If it could hold and build off of that, that would definitely be a better place to, be like, yeah, okay, we've got some momentum going into this towards the upside. But yeah, right now this looks really weak. I don't think I would be jumping in this long. Maybe a potential short, but still, I don't know. I kind of feel like we missed the short opportunity. Riz, what are your thoughts?
Yeah, I agree. Definitely not a long after the gap up there. Obviously it's not at all-time highs, but about $20 from all-time highs. Not personally my kind of favorite setup for going long at all. From a short standpoint, I think it's definitely a little bit more plausible for a short, but even that isn't ideal. Maybe we see it eventually fill this gap, lower to the 210. But I think that's going to be also very much conducive to how the market is. If you have a bearish position on the market, or if you have a bearish thesis on the market, and instead of shorting the market outright, and you want to short a stock, and I think one that will usually move larger because it's a higher beta stock, this could be a short if you have that thesis, right? But from a pure, disregarding anything from a market standpoint, purely from a technical setup here, more so in the not touch type of camp. But if I had to lean one way, it's definitely a little bit more bearish than bullish.
Yeah, for sure. I wouldn't touch this. Day traders like this one too. But yeah, I would be careful because this thing moves big. I mean, look at some of these candles are just massive. So there is a lot of intraday volatility on this one. So be very careful, and you got to have some, let's just say some cojones to hold through some of these candles because it can be very jarring. All right, Keely wants to know if we have any thoughts on CTRA. That one's not ringing a bell for me. Coterra Energy Incorporated. I think it looks like junk, if you ask me. This is a pretty low dollar stock here. So really kind of I want to say in general, a fairly slow mover. It doesn't seem, but I mean, yes, it can dump, obviously. But yeah, I'm not overly excited about this one. Really, just a lot of chop, if you ask me. I wouldn't touch this one. Riz, where are you on this?
Yeah, if I'm not mistaken, I haven't traded it before, but it's just a utilities, Chris. If you open up the right hand side top, yep, and then let's see what we got here. Let's scroll down. What's the yield? So it has a little bit of does it have a dividend yield as well right there? Yeah, it's 7%, 7.5% dividend yield. Which so it's a decent dividend, but of course I think this is a utilities stock, if I'm not mistaken. Yeah, okay. All right, actually a
Energy
pure play
company.
energy, okay, oil company. Okay, so yeah, this is definitely a smaller oil company. I wouldn't say it's not a penny stock, but it's definitely a smaller energy play. Uh, from a oil standpoint, yeah, as you can see, it's run up a little bit over the last month and a bit after some consolidation. Has a good yield, but definitely not one of those pure, strong, large cap oil producers like we have when it comes to Exxon, when we have Shell, when we have Chevron, when we have Occidental, we have these others, right? So I feel like there's a lot more like stable opportunities, but of course you're not going to get this kind of yield, right? So it depends kind of what you want. Do you want a little bit more exposure and risk? Then this might be it because you're getting a 7.5% dividend yield. And potentially it's kind of, you could make a case this is a nice breakout, right, from that consolidation out of the 26 area. So just be careful, like look how it's kind of consolidating a little bit and maybe kind of tilting a little bit lower. Could be like a little bit of a flagging there. You want to be careful if you take a long there. Make sure you have like potential area you'll just get out, maybe 27, maybe 26.50, and you'll just take the loss unless you are confident in the fundamentals, which I obviously haven't looked at in details. And I haven't traded this stock before. But remember, take a long, just make sure you don't end up being a bag holder, because what if this ends up all the way back to 24, right? And then you're just, you're getting a nice dividend yield, but you're kind of stuck.
Yeah, for sure. For all of our people who like flags, there you go. There, that looks pretty nice. You can go with that. And then we can throw, like 5 other different lines here to make it incredibly confusing. So you have no idea what you're looking at. But yeah, we don't really trade flags here. But yeah, just not super confidence inspiring, in my opinion. Definitely have a hard stop if you want to go for that one. All right, let's go to Jeff's question, because I think this is a great one to end on. We kind of talked about it earlier. It just says, speaking from a more macroeconomic view, looking at housing supply, demand, and expense, is there a trade there? The current environment appears to be incredibly unsustainable. I have to agree with you on that. Riz, this is definitely a question for you. I mean, me personally, if I'm looking at real estate, if we're talking about physically owning real estate or something like that, owning a property, I feel like now is a really bad time to buy, especially with the way interest rates are, kind of like what we were talking earlier. But who's to say that property values don't continue to increase? Riz, what are your feelings on this?
Yeah, we did have a little bit of a real estate chat earlier. I think you're right in terms of this kind of pricing not being sustainable, but keep in mind it's also very geographical dependent. Some states, some cities, prices are still reasonable, palatable. Others, it's the complete opposite. It's over exuberant. It's irrational. It's very frothy. So again, it's very dependent from geographically, but from a economic standpoint, yes, I think it's pretty clear. And I agree with you that you know what, there's too much. It's too costly to really do much. We've already seen that kind of translate into the housing market already, where transactions just aren't happening. The biggest people who are not happy are real estate agents, because they don't get to get the commission off of every sale, because there aren't too many sales happening. So they're hemorrhaging a bit. Obviously, I don't think we're in like a 08 07 scenario at all in terms of a housing crisis or like a financial collapse, but we could definitely see that, if again, this is a big if we see a sizable cool off in housing prices, people are automatically going to be like, oh my God, it's going to hurt them where it hurts the most, because that's their home, that's their house. And even more so if they have investment properties, and they're going to be like, oh my God, it's going to hit them. And I think at that point, people are going to be more cautious in how they spend their money and how they use their discretionary income and wealth. And when that happens on a more of a larger scale, we then start seeing a slowdown in spending. And as a result, we might see potential recessionary data points come up. I'm not going to come out and say that we're going to see a recession exactly, but something to think about. I will definitely, obviously, be keeping everyone updated as things come from a data standpoint, but also from my views and positioning standpoint, obviously, as things go. But as of right now, for the webinar purposes, and for those not in elite, I think it's definitely plausible to say we could see a potential slowdown, but it's too early to come out and say, yeah, we're going to see a recession. I don't believe in doom and gloom. I believe in making sure what I say is corroborated by data.
No, that's a really good point. And I got to tell you, Riz is saying all the dirty words here on webinar tonight. He said recession. He said COVID. He dropped an F-bomb with the people talking about the market with Powell. I mean, I may have said fall, but Riz has said all of the dirty economic words here. Um, Again, kind of building on that a little bit, in my feeling, with real estate right now, at least in my area, I feel like prices are way too high. I think that, post the events of 2020, everybody started moving out of the cities and into the suburbs, kind of like where I live. And, we see the prices going up. We see that in lots of places, especially, sunny places like down in Florida. I have a friend who lives down in Florida. It says prices are just insane right now compared to where they were 5 years ago. And it's tough when you have prices jump up like that. Of course, it's I'm thinking to myself, yeah, my greatest investment, right, obviously is my home. It's where I'm putting the majority of my funds at this point. And you see that price going up and you're like, oh, well, I should sell. But then, kind of like we hinted on earlier, well, where are we going to go? Because it's not like you can just hop up and buy another property, because a lot of people who refied during those really low interest rates during the pandemic aren't leaving. And why would they? They had a freaking insane rate and they got it locked in for, however long they needed to refinance. So it's really difficult right now with real estate. And yeah, I have some real estate friends too who are definitely hurting. You're definitely right on that one, Chris.
Yeah, it's interesting, and I think it's only going to become more and more clear as we get into the next few months and heading into 2024, where we start seeing something crack. Something's got to give.
Yep.
It's like a what's that game you play with a rope, two sides pulling? What's that?
Tug of war.
Tug of war, right? And yeah, the two sides are pretty much evenly matched, but eventually one or the other is something's got to give. And I think it's going to be interesting to see what direction things lean in. I can't for sure, obviously, say like, oh yeah, okay, housing prices are for sure going to tank. But if I were a betting man, if I were to pick one side to put my money on, and I would bet on the side that's, that's kind of it pushing or pulling towards a little bit of a slowdown or a downturn in housing prices.
I agree with you on that one. Thank you, everybody, for coming out tonight. I really appreciate it. Again, if you're watching the replay, make sure you leave us a comment. Let me know what you think about our two different views for the S&P 500 and what you like. I'm not changing it until at least 20 comments I get. So I want to see that on this video. If you made it this far, you can at least leave us a comment, and we will see you in the market on Monday.